Hello, everyone. I am Faria Hashmat, and your convener for panel 52b. Well, first of all, I would like to welcome you all to our panel, which basically focuses on the social and economic impact of COVID-19 on MFIs and their beneficiaries. Well, before starting with the presentation, I would like to mention that each team of presenters will be given 25 minutes in total, 20 minutes for their presentation, and 5 minutes for their question and answer session. And we'll be grateful if you will try to finish the presentation in time. So I would quickly go through the order of the presentations. Our first presenters are Philip from the University of Ghana, King Carl from Data King Consulting, Divine Mense and Joseph Mense from the University of Ghana. They will be presenting on income diversification strategy and profitability, insights for post-COVID microfinance industry. The second presentation is by Olemi from Edo University, Ayamo, which is on COVID-19 and microfinance institutions in Nigeria. This presentation will be followed by Marco and Angelina, who are from Christian Action for Development Board, South Sudan. They will be presenting on the impact of COVID-19 on the efficiency of microfinance institutions in South Sudan. And lastly, the last presentation for the session is by Zainab Said and Rushania Zafar from Kush Foundation. And it is based on the role of microfinance in ameliorating the economic effect, financial impact of post-COVID recession. It is an evidence-based actions by Kush Foundation, Pakistan. So without further ado, let's start off with the presentations, and the stage is all yours, Philip. You are going to present first.
All right, so I'll share my screen.
Yes, please.
Let me know when you can see my screen.
Yes, we can see your screen. Perfect.
Yeah. All right. Okay. Can I go ahead? Okay.
Please.
Hello, everyone. I'm Philip Elpimagomo. I'm presenting on the topic income diversification strategy and profitability, insights for a post-COVID-19 microfinance industry. I'm presenting on behalf of King Carl Tonam Duhu, Divine Mensa Duhu, and Joseph Mensa Duhu from Data King Consulting and then University of Ghana. My presentation will follow this outline from introduction to objectives. Then I'll give a brief literature review. After that, I'll give an overview of Ghana's MFI subsector. Then I'll discuss my results and findings. Then I'll conclude and provide implications for policy and practice post-COVID-19. Okay. MFIs are basically set up to meet the needs of small and medium-sized enterprises and low-income households. Are set out to render financial services to this group of population. That's their target. They're supposed to not only provide financial services, but they also have to provide social services. Aside the financial impact they have on the community and economy, they also have a social impact by providing some amenities in the communities for the population. The industry was heavily hit in 2020 by the pandemic that affected each aspect of the economy. So from loans from businesses to income to personal income, everyone was affected. And then this has some negative effects on the financial performance of MFIs, but it also brought about some social benefits that MFIs could give and create to low-income households. So MFIs derive their revenue from interest income. That's the income that they give to borrowers. That's the loans they give to borrowers, and then the interest that is charged on those loans. That interest is a source of income to MFIs. Then there's also another aspect, another stream of income, which is non-interest income, which includes commissions, fees, and investments in government securities and what have you. So the question that is guiding this study is whether MFI should aim to diversify or should focus on a particular income generating model. either to focus on interest income or to also balance interest income and non-interest income. After the pandemic, the interest rates have drastically fallen, and then MFIs are thinking of ways and strategies to revitalize after the COVID-19. There have been studies in this area, and most of the studies have been on banks, especially the financial sector, have been on banks, and there is lack of study regarding MFIs. That's when it stays the study. Okay, so as we aim to examine the effects of income diversification on financial performance of microfinance institutions. For financial performance, we are measuring them by return on assets and then return on equity. So an overview of literature in this area. Lam et al. Find evidence to indicate that for-profit MFIs tend to convert financial performance to achieve social performance, while not-for-profit MFIs I would convert social performance to financial. So there's a bit of inverse performance arena in terms of MFIs. Then another study by Houdon, Labby, and Richards explored the fairness of profits among MFIs using a framework that focuses on profitability, social mission, pricing, and supply distribution. So we see that MFIs have goals with respect to being profitable, having a social mission, pricing, and distributing their profits. So sometimes I've found emission drifts from group loans to personal loans. Over time, Zamo has found in the US that MFIs are drifting to more of non-interest income, where when they take deposit, they're focusing on gaining returns from investments and other avenues other than giving out loans to circulate money in the economy. A bit on empirical review in this area. Berger, Hassan, and Zhu found evidence to suggest that diversification has a negative effect on performance on small banks. And Goddard, McKillop, and Wilson studied 3,000 US microcredit firms and found evidence suggests that income diversification is only beneficial for large firms, but is detrimental to the profits and performance of smaller firms. His argument was that small firms do not have the capacity and then the resources to focus on diverse areas or diverse streams of income, but for large firms, they might have the capacity to have different streams of income. Zamo in 2018 found that income diversification improves both sustainability and profitability. His study was also on MFIs and has found a positive impact of diversification on profitability. So an overview of Ghana's MFI subsector. And the subsector in Ghana is grouped into four, depending on the reach of the company. That's how wide, in terms of geographical location, the company can cover. And then the capital requirements, and then certain activities that they're allowed to engage in. So under tier one, we have savings and loans companies, rural and community banks. In tier two, we have credit unions and microfinance companies. In tier three, there are financial NGOs and money lenders. In tier four, there are individual social collectors and individual money lenders. They all have their various specializations in terms of geographical areas that they seek to operate. So one major development in the Ghana's MFI subsector, which kind of affects our data, is that before there was a cleanup by the regulator in 2017, which sought to close down MFIs that are illiquid and incompetent. So before the cleanup, we had 484 institutions, but after the cleanup, there were 134 institutions. The cleanup was very important and helped the financial stability of the economy, since the capital allocation ratio increased from 8% to 31%. So a methodology on the data. We used quarterly data from 2016 to 2018 of microfinance institutions in Ghana. Analysis was based on that data. So here are the variables that we employed in the study to assess the impact. So for profitability, in accounting literature, it's common for return on asset and return on equity to be used as a measure of profitability. Return on asset was computed as profit before tax over total assets, and return on equity was computed as profit before tax over shareholders' funds. Then for the independent variable, which is income diversification, we use two metrics. Sorry. So the first metric was calculated by 1 minus the absolute value of net interest income minus non-interest income all over total income. Then our alternative measure of income diversification was calculated as 1 minus net income over total income all squared plus non-interest income over total income all squared. Then based on literature, we controlled for 3 variables which could affect the impacts of income diversification on performance. So size, which was calculated as natural log of total assets, and then asset tangibility, which was calculated as total fixed assets over total assets. Then deposit to loans and advances ratio, which measures the liquidity of the company, which was calculated as deposit over loans and advances ratio. In our model, we use a regression model, which is modeled after earlier studies by Zamo in 2018 and Duho et al. In 2020. So we developed a model we developed 20 models because we had 2 measures of income diversification and then 2 measures of profitability. So a model for 5 models for return on assets, 5 models for return on equity, and then we iterated the same thing for the alternative measure on income diversification. So I present to you the results that we found in the study. Okay, the second column shows our observations. We had a little over 3,000 observations. Then the mean, you see from the return on assets and ROE that the ratios are low, 0.001 and 0.000 respectively, which implies that the MFI sector in Ghana is not that profitable. It's like for every CD investment in assets, there's only 0.01 pesos gain on return for investors or in terms of total assets. Then for income diversification for both measures, we had figures below 0.5. For first measure is 0.3, and the second measure is 0.2. We realized that MFIs in Ghana are focused on a particular strategy, either non-interest income or interest income. They are not diversified. From the last row, the deposit to loans and advance ratio, we see that the ratio is very high, meaning that there are a lot of deposits, but the loans are relatively low. So it implies that the focus strategy of the institutions are towards cash securities, government securities, bonds, and other investments, or it could be in terms of fees or commissions. Then from the standard deviation, we see that there's a low standard deviation, which implies that majority of MFIs are clustered around the mean and the average. So there's that commonality, and they are operating under similar conditions and operations. Okay. Then we conducted a correlation and multicollinearity test to ensure that the right variables are included in a particular econometric model. So the relevant column here is the VIF, the variance inflation factor, which gives us an idea as to which of the variables are important or can be used in one econometric model. The sum of all the VIF is less than 10, which implies that it can be used in the same econometric model. And when there's a high correlation between 2 variables, then those 2 variables are also to use the same regression model. I solidify the assumptions of the regression that we use. So here are our regression results. This table presents regression results on the return on assets. Okay, so you see that income diversification is significant at 1% significant level for 3 models, and then the significant results are having a negative impact on profitability. This means that as MFIs in Ghana seek to diversify and obtain more grants, they tend to have worse performance. The performance is worse off. Then in the second model, we try to find a combination effect between income diversification and itself, which is income diversification squared. And it also had a negative effect on profitability, meaning even in the long run, there is still it still has an adverse effect on profitability. Then in the fourth model too, we see that income diversification, when combined with tangibility, might have a little bit of positive effects on profitability, and this effect is significant. Then from our R squared, you see that the models are quite fit, very fit, 80% and above. And the fourth model seems to be the best explanation model. And then for our control variables, for size, see that size has a positive effect on profitability, and this cuts across all the models. Tangibility has a significant effect also on profitability, and then this effect is quite large. For profits increased by 0.52 per each unit increase in tangibility is huge amounts of effect. Then deposit to loans and advances ratio has a negative effect on profitability. So this implies that when MFIs are not focused on loans, on giving out loans, when they seek to increase the ratio between their deposits and loans and invest in government securities, it negatively affects their performance, because it could be that since they're not giving out loans, the economy does not grow easily, and then business are not springing up in the community. So this is where the findings we found on return on assets. Then the second table provides the models which had return on equity as the dependent variable. And fortunately, we see the same results that was seen on return on assets. The effect of income diversification is negative, and then the other control variables are significant across all. Then with our alternative measure of income diversification, it's also consistent with the previous results in the first two tables. And then we see high R squared in all cases, which means that our results are consistent, and then it is true and significant that income diversification does not have a good effect on profitability, contradicting ZAMO 2018's results. Then to the conclusion, we found a negative impact of income diversification profitability in the short run. Then also found that income diversification has a negative effect on profitability in the long run, right? Then one interesting finding that we had was that in the knowledge economy, where we expect that intangible assets and intellectual capital should be a boost to profitability and performance, in the MFI subsector in Ghana, tangible assets play an important role in performance. That was one thing we found. Then we found that diversified firms are able to benefit from profitability if they have a high amount of visible tangible assets, right? So here are the implications that we have for MFIs, for policy and practice going forward in the industry. So realize that there is a low level of financial intermediation. Firms are not giving out loans. This is because the industry that itself are not well captured and are under the low income segments of the country. And then they're not able to rate them in terms of credit rating and to be able to follow up on them to pay back their loans. So we realize that MFIs tend to diverge to investing in government securities. However, the pandemic that has affected the financial performance of all businesses across industries require that individuals and micro enterprises get access to credits and funds to be able to boost economic activity to mitigate the effects of the pandemic. So since we found a negative effect of income diversification on profitability, it is imperative that MFIs focus on a particular strategy, either on non-interest income or on interest income, so that they can benefit from the specialization. Just as the strategy focus theory says that when an institution focuses on a particular stream of income, it's able to generate expertise and efficiency in that area. There are some theories and concepts against pursuing a focus strategy, but from our research and results, the focus strategy seems to be better. We found the relevance of tangible assets in the African context. So we recommend that MFIs acquire fiscal assets that improve the visibility of the company in the community and area, because this also serves as an advertisement, and it brings trust to the microfinance institution. Then we recommend that the MFIs leverage modern technologies and data analysis in optimizing their operation, in reaching borrowers, in attracting new clients, and ensuring that the best methods of investments are carried on. Then we recommend that the menu of policy discussions should include risk management issues, corporate governance concerns, and revitalization after the pandemic. Because before the financial cleanup, there were a lot of corporate governance concerns where at the governance level of MFIs, people who were managing the institutions were not qualified, didn't have the right expertise in managing financial institutions, in assessing loans, in assessing credit risks, in assessing liquidity risks. So we recommend that there should be discussions around risk management issues and corporate governance. And here are the references, and then I think that's it. Thank you very much.
Thank you very much, Philip, for your presentation. Well done. We'll have a quick round of question and answer session. So do we have any questions? You can either type in the chat or raise your hand, or just open your mic and ask the question.
I've got a question.
Yes, Dr. So, please.
Yes, so thanks for this, Philip. Now, recently, the Ghana banking system has been through a lot of crises. There's been a lot of issues with corporate governance, and about 7 banks were shut down in the past couple of years. Most of these issues were relevant to corporate governance, to non-performing loans, high-risk credit, regulatory lapses, and these kind of things. So what about the microfinance sector? Is there anything like a Microfinance Act, or has there been any revamp of regulatory policies to make sure that the MFI sector does not suffer due to these kind of corporate governance issues?
Okay, yeah. So after in the banking sector, after the revamping and the cleanup,
yeah,
in 2017, the same thing happened for the microfinance industry. A lot of firms were closed down because they were not liquid enough. They didn't have the right amount of capital. And then some had fake documents to get the license to operate. So after the cleanup, under the Banking Act, it has been updated. It has been improved upon to include certain regulations for MFIs. So right. As you can see, I showed the different tiers under the MFI subsector. Their minimum capital requirements have been increased so that MFI institutions are strong and liquid enough to provide support to their communities. Then there are also regulations as to, there's tightening regulation on to getting licenses to operate. The processes are now tighter. Then there are also regulations as to the management and the governance of these institutions. The directors and then the board of directors and then the managers are supposed to have certain qualifications to be able to sit on the management of MFI. So these are some of the policies and measures in place.
Okay. Okay, that's good to know. So this is the central bank which is intervening. It's you call it the Bank of Ghana, isn't it? The
yeah, the central bank.
Yeah,
Bank of Ghana.
Okay, thanks. Now the other thing is you mentioned about diversification and how it becomes risky for MFIs to become more diversified and thus risky in terms of generating income. So there's been a lot of literature on strategic management, and Michael Porter and all of these have done a lot of work on this. And what they came up with is that if it's related diversification, then it's going to benefit the organization. If it's unrelated, then chances are that it's going to be a bit risky. So within MFIs, if they diversify in a related kind of an aspect, then it should be helpful. So when you, I don't know how far you've written this paper, but when you develop it, then it will be helpful to clarify whether you're talking of related or unrelated diversification.
Okay, thank you very much. We'll go further to examine whether there is a significant difference between related diversification and non-related. But for this study, we limited it to interest income and then non-interest income. Those were the only measures used for income diversification, not measures of related and not related. So it's either diversification, it's either focus strategy in interest income or non-interest income. We didn't consider the other non-related areas. We'll consider that in further studies. Thank you very much.
If it's related, then if it's microinsurance, for example, which they have a product for farmers, then that's going to be related. That's going to be within that aspect. But if MFIs are going all over the place, like some of them are doing, and then they get into trouble, then that's completely unrelated. So that's a kind of area. Okay. All right. Thanks. That's all that I wanted to.
Well, we have a question from Emma Nawaz.
Yes, Faria, thank you. Yeah, I have a question, Anthony. It's just a very nice presentation. Just in the context of what Asad has already been asked, I think it would be great if you, on the right-hand side of your equation, if you create a sort of dummy variable about the categorization of MFIs, because it's still, I guess it's very heroic to assume that overall all the microfinance sector that that diversification leads to lower profitability and all that, because it really depends on what sort of MFI you are talking about. I mean, it's an NGO, credit union, or whatever, the conventional financial intermediary or whatever. So it really depends on that thing. So if you have that particular variable, which you have mentioned, I think in your initial slide, in the backdrop, you have mentioned that these are the sort of MFI sectors, you know, they're comprised of these sort of MFIs in terms of their legal status and whatever. So if you include that thing on the right-hand side, probably then it would be more helpful to clearly identify what sort of MFIs really need that policies. Particularly because still you can't, for all the microfinance sector, you can't say that diversification in general leads to lower profitability. So I think probably you can incorporate that thing into it. That's the thing. And the another one is that, again, if you somehow have that interest rate thing, because there is, of course, a lot has already been said, and it's a highly researched area that there is a mission drift sort of thing. So again, it really depends on the MFI's overall objectives, whether they are NGOs or whether they are purely commercial entity. Because that creates variations in terms of their policies, in terms of all that strategic management, and where to put their assets or diversify their assets. So I think that variable would quite helpful if you control for that on your right-hand side. So these are just suggestions. Thank you. Over to Faria.
Very much.
I'll add something quickly to that, that when you write this paper, then say that what is the scope of your MFIs? Which ones are you considering under this? And then you won't get into any trouble. So otherwise MFIs can, you know, they can include all sorts of. So once you set the scope and you limit it, then you should be fine.
Thank you very much. I'll consider that.
Okay, we'll move on to the next presentation. It's by Olemi, which is on COVID-19 and microfinance institutions in Nigeria. So, is she here? Yes.
Okay.
You have 20 minutes for the presentation.
Good afternoon, ladies and gentlemen. Can you hear me?
Yes.
Yes.
Okay. I am Olaimi Bondide from Edo State University, and I'll be talking about COVID-19 and microfinance institution in Nigeria, using LAPO institution as a case study. Microfinance is no stranger to crisis, but the COVID-19 is different. Unlike previous downturns, which originated from financial markets, the current crisis is spread through an invisible virus, which is difficult to contain and control. The virus not only negatively affects businesses, commerce, it also kills people in numbers unseen for a century. It creates social disruption and changes the way we live and work. So microfinance institutions and other providers, banks, to non-government organizations face threats to their own existence. The diminished earning capacity of their clients threatens to undermine the strong repayment culture on which microfinance depends. This paper explores the effect of COVID-19 pandemic on the performance of microfinance institutions and how their clients are able to repay back the loans that were being borrowed by them. As the COVID-19 pandemic continues to devastate the local and global economy, microfinance has become more critical to the survival of the poor and near poor people in developing countries. Microfinance institutions provide the best access to banking services for the majority of such underprivileged populations whose livelihoods have been worst affected by the pandemic's disruptions. For a country like Nigeria, experiencing mass poverty, steep unemployment, and other serious socioeconomic challenges, the implications are dire. It means that millions of people or poor citizens among the 40% of the population will find it difficult to get back on their feet without the sort of services and support that microfinance institutions provide. It goes without saying that the effectiveness of Nigerian microfinance institutions will be critical to rebuilding the economy. One of the major players in Nigerian microfinance institution is LAPO, Lift Above Poverty Organization. This microfinance has an extensive network of branches across the country and accounts for over 27% of the microfinance sector. LAPO Microfinance Bank has approached the challenges of the pandemic with its trademark and thoroughness. It has made significant strides amidst the historic disruptions brought on by the pandemic, which emerged in the country just over a year ago or 2 years ago. It has sustained its support, a total disbursement of 12.2 billion naira as loans to 1,052,446 rural farmers and owners of small medium enterprises in 2020. Announcing these milestones recently, Dr. Honestus Obiadiora, LAPO's acting executive director, said the loans were disbursed in 253 branches across 21 states. They were able to achieve this despite of the pandemic and are committed to sustaining the financial support through development plan to open more branches. LAPO Microfinance Bank has recorded other notable achievements during the pandemic, including the launch in February 2020 of its second bond of 6 million naira fixed rate. However, even with such stellar achievements, LAPO, like other microfinance institutions, is weathering significant challenges due to the pandemic. A survey by the Consultant Group to Assist the Poor, CGAP, a global partnership of more than 30 leading development organizations that works to advance the lives of the poor, are dealing with rising debts, bad debts, and now account for up to 30% of their loans. Now, looking at these challenges, prior to COVID-19, these microfinance institutions, they were able to disburse out loans to their clients, and the clients will pay back to them in due time. But due to COVID-19 pandemic, because of the lockdown in Africa and comes across down to Nigeria, a lot of these clients were not able to repay back their loans. because they're not striving in their businesses due to the lockdown. I had some interviews with a worker from Asha microfinance institutions, and he said during the COVID-19, some of their clients were not able to repay back their loans due to COVID-19 pandemic and the lockdown issues. And they had bad debts arising to over 1.6 billion naira. And most of their staffs did not receive their benefit, their emoluments due to the COVID-19 pandemic. And this had a lot of effects in their institution. I went further to ask him if they still disburse out loans to their clients. He said yes, but not as before. That before COVID-19, if a client comes to ask for a loan of 1 million naira, they will easily give the client. But due to the pandemic, they split the loans in two places. Instead of giving out 1 million naira, they gave out 500,000 naira. This is a major issue because most microfinance institutions operate with little savings, expecting that small loans will be repaid in a timely fashion and with a low default rate. The fallout of increasing defaults due to the pandemic is that microfinance institutions in turn face challenges repaying banks and their investors. It is also noteworthy that the pandemic disrupted business operations of many MFIs considerably. Like its counterpart, LAPO, has had to alter physical and on-site operations, especially at the state of the pandemic. They altered their operations to ban demonstrated commendable foresight by closing down its on-site operations across Nigeria in the year 2020. While the pandemic persists, microfinance institutions continue to face challenges meeting physically, communicating, collecting loan repayments from their clients. International industry experts believe that now more than ever, the value of digital financial marketing, such as agent network, e-wallets, and mobile banking are vital because these technologies allow for continuity of service and spare customers the risk and inconvenience of traveling to branches as well as products, as well as to protect staff of the microfinance institutions. LAPO is in a good position to embrace such recommendations to further digitize operations because of its already existing culture and technological innovation. Finally, robust policy support by government is required to assist microfinance institutions to maintain asset quality so that they can continue to give out new loans to their clients despite the COVID-19 pandemic, and in turn expect back the loans from their clients by paying back their loans in due time. It is therefore critical for policymakers to make necessary adjustments to extant laws and regulations to achieve the vital objectives in order to stave off deepening inequality and poverty, to give those at the bottom of the ladder a lifeline at this very challenging for the local and global economies. Thank you so much.
Well, thank you, Olemi. Do we have any questions? Well, if we don't have any questions, I think we'll move on to our next presentation.
Ahmed Nawaz would like to ask a question.
Oh yes, Dr. Ahmed.
Yes, Liam, it's a good presentation. You sum up the whole situation very well, but I'm just wondering, is it based on your research? It's based on some sort of interviews you conducted, in-depth interviews with all the stakeholders, or it's sort of survey-based sort of research?
Hello?
Yeah, Liam, are you hearing me?
Yeah, I can hear you.
Okay, good. That's good. Okay, it's a good presentation. I'm wondering, just a very small question. Is this your research based on some in-depth interviews with all the stakeholders. It's a sort of qualitative research. You conducted interviews with the respondents, with all the stakeholders, those who are at the helm of affairs in the microfinance sector over there. Is it?
Yes, sir. Yes, sir.
Okay, good. Okay, thank you. That's all I need to know. Thank you.
I had an interview with someone from Aisha microfinance institutions, and it was like I said, he was able to tell me that sir, can you hear me?
Yes, please. We are listening you.
Okay, sir. So he was able to tell me that during the COVID-19 pandemic, before the COVID-19 pandemic, they disbursed loans to their clients, but due to the COVID-19 pandemic, as of last 2 years, 2019, 2020, a lot of their clients would not pay back their loans. They were having complaints like the lockdown, their business were not thriving, and everything. So they had bad debts of over 1.6 billion naira because of the lockdown issue. Then I asked him, I said, what about now? Are they still giving out loans, despite the fact that those clients could not pay back their loans? He said yes, but they're not giving the full amount of money. They'll split it into two. That's what they do now.
May I ask you something?
Okay.
Are there any more questions? Aisha, do you have a question?
Yes, I would like to ask her something. She just... Hi, Oliami, can you hear me?
Yes, ma, I can hear you.
For providing us this information. You just mentioned that women were having problems paying back the loans, and they were splitting the amount in two, and that's how they were paying off their loan. So I just wanted to know, like, were they able to pay back the loan even in, two different at two different time periods, two different installments? Were they able to manage that also?
I'm sorry, ma, I can't hear you. It's not audible.
Can you hear me now?
Hello, can you come again?
Yes. Can you hear me now? I hope you can hear me now.
Yeah, I can hear you now.
All right. You just mentioned that women who were having difficulty paying back.
Ma, you were saying?
You just mentioned that women who were having problem paying back their loans were given this
Yes, yes.
this privilege to pay back the loan in two different installments, right?
No. Okay, what I meant was, ma, can you hear me?
My only question or the information that I would like to have from you is that were they able to pay back in, in further installments?
Oh,
Yes or no?
no, ma.
What about it?
Okay,
Yes.
okay. Can you hear me?
Thank you. That's it. Please.
Okay, thank you.
If we don't have any more questions, we should move on to our next presentation. Marco and Angelina, they still haven't showed up, so I would request Roshane to please come on stage. Roshane Zafar.
You just
Can you?
share your screen. Yeah. You guys see my screen?
Yes, we can.
Okay, wonderful. Okay, so we're going to move a little away from Africa and move to Pakistan and talk about the overall impact of COVID on the informal sector. So if we look at ILO research that was done last year to see what impact the COVID-19 was having on the informal economy, We are seeing a huge impact there. A majority of the people losing their jobs are semi-skilled women, young workers, or low-skilled workers. So the job losses are more in the unskilled sector, especially women. What we're also seeing is that according to data coming from the ILO and the World Bank, that there'll be a greater number of people in extreme poverty. The calculations are vary, but the one that the World Bank is saying is about 96 million people who will be pushed through into extreme poverty. And 63% of the contribution for this will be coming from South Asia. So what we are seeing is that COVID is generating further income inequality across the world, even when we map it through Gini coefficients. However, there is a gendered impact of COVID-19. As I was sharing already, 47 million of the 96 million that are predicted to be to move into absolute poverty, more of them will be women. 47 million of those will be women in terms of the impact on women. What we are also seeing is that women, because they're part of the informal sector more, are the ones that are losing jobs, and the probability of losing a job for women is 19% more than that for men. So again, we are seeing the loss of jobs, the loss of livelihoods for women. And this is something that's also being mapped in the work that we are doing with micro entrepreneurs across Pakistan. If we look at the evidence from Pakistan, currently 73% of the informal economy in Pakistan comprises of women. And this is data coming from the PBS, the special survey that was done to look at the impact of COVID on job losses. 20 million people have lost jobs. Mostly, a majority of these would be informal workers. And if we typeface that to the informal economy, the face of unemployment is women. We are seeing 12 million home-based workers that are being impacted by the pandemic. Again, these are women. And women are more likely to lose their revenues. This is more from the economic perspective. But if we look at the human development perspective of this, there were 26 million children who dropped out or unenrolled from schools. What that means is this is post the lockdown down. And 13 million, almost 50% of them haven't come back to school, of whom 60% are women. So women girls post-COVID are less likely to come back to school, which then propagates the intergenerational impact of poverty. So if we put this all together, one of the things we did immediately after the lockdown in March was to do telephonic interviews in April 2020 with about 2,000 of our clients to understand what was going on with cash flows, with ability to pay, with the transactions, with the budgeting, and with the income. And what we saw is that post the lockdown, the first lockdown we had in March 2020, 92% reported a decrease in income. And essentially, these were women-led trades that we saw since Kush works primarily with women entrepreneurs. These were women-led trades, including stitching, cloth trading, beauty salons, schools that women were running, what we call low-cost private schools. So again, the impact, the burden of loss of income was higher for women-led businesses. This hasn't, so we continue to do a longitudinal analysis, and we tracked 300 of the micro entrepreneurs we spoke to in April to see what happened to their incomes. And what we saw is that there's a very low impact in terms of businesses coming back in October. However, there is a turnaround, and I'll talk a little bit more. 16% of clients started reporting increased income in terms of changes in the income. So we do see a slight change. We'll see it's a U curve that we are seeing in terms of income increase. At the same time, we have business losses for the women because they couldn't transact the returns post the lockdown. They lost their markets, they lost their returns, they lost their opportunities. So what we also saw was that Pakistan is facing food inflation. Now, low-income households contribute a huge percentage of their budget to food expenditure. And if we see at the bottom, you will see of the chart that there has been a substantial increase, a 16% increase as a percentage of food that is spent out of income over this period. So again, food security, food dependency is becoming a major issue in households, and that has created a longer tail for COVID for not only women-led households, women-led businesses, but also for low-income households at the same time. If we look at the change from a cash flow perspective, how are people handling both the income loss and the inflationary impact on their budgets? So what we've seen is over the three time periods that we were looking at, in March, people were not reducing their food consumption, but between October and April, we are seeing an average of 16% in terms of quantity of food being consumed. And this will have an impact on families over the long run in terms of their morbidity and their mortality and their health. People have also cut back on their household expenses. And when we looked at coping mechanisms in terms of what did they cut back on, we saw one of the first cutbacks was on children's education. Again, that has an intergenerational impact. And the third thing we saw is that people started borrowing. So one of the things we are seeing is, and this is something microfinance can learn, in addition to people drawing down on their savings, they were also coping with the cash flow management by borrowing more. So there is a need to develop what we call consumption lending products. Essentially, microfinance tends to look at productive lending, not consumption lending. So this is something we need to look at to help low-income households manage consumption smoothing for this period. In terms of economic impact, what we have seen is overall people are working more hours to make up for the difference. People have also added new businesses. If we look at the three timelines, on average, 6% households that we interviewed started a new business or a new job to bring in income. And unfortunately, one of the negative impacts we are seeing is that people started, especially in April, because the tail has been longer, as I shared with you, due to the inflationary impact. The economic recession that COVID generated was further impacted by inflation. People have also started sending their children for domestic work. And again, as you know, there is a labor supply for children in Pakistan, unfortunately, despite that there is a law that limits children being involved in productive work. But we all know that that's not something that curtails this from happening. So these are the kind of reactions we are seeing. So I've already talked about generally what we're seeing in terms of business loss. So if we look at the entrepreneurs or the businesses that we were supporting, 69% have still not been able to recover their pre-COVID levels. But there is, in April, we are seeing, when compared to October, we are seeing greater revival in businesses. So there is a general sense of optimism. People are beginning to, earn more from their businesses. However, household income changes are very few. What that means is that people have lost their jobs, and jobs are harder to come by right now. And that in itself is impacting the ability of households to rebound back. But one of the things we have seen is that micro entrepreneurs have been resilient despite the fact that you have COVID-linked recession. So what have microfinance institutions done? There was an international survey conducted by CGAP in October, November 2020 to see what kind of strategies were MFIs using. So what we did see, and that happened in Pakistan as well, majority of MFIs rescheduled and provided ease of repayment, because these were not willful defaulters, these were circumstantial defaulters, and everybody was in the same boat, and we really needed to reschedule and provide flexibility in payments. On the other hand, we have seen about 1/3 of MFIs, and again, that is true in Pakistan, including for Kashf as well. We have been recapitalizing businesses because, as we have seen, businesses lost their sources of income and their markets. So we needed to bring them back on board. Then what we're also seeing is digital solutions being used by MFIs. So 40% of MFIs are using digital solutions, not only for their business, but also for the clients to help them set up, the use of social networks, use of web-based solutions in terms of getting their products out. And then we have had organizations building insurance and other services into so that the bandwidth of social safety can be strengthened for such households. So these are some of the mechanisms used by MFIs. We did similar things as I already shared, so I'm going to quickly skip this slide. We ran ration programs for our clients. We did rescheduling. We gave credit lines to clients. We helped women get back to business through trainings for digital channels. And we also helped provided emergency loans to pay emergency expenditures, which were then paid back by the clients to help the consumption smoothly. So these were some of the mechanisms we've used. Unfortunately, COVID is going to have ramifications for gendered outcomes. We do know currently Pakistan is lagging behind on many gender indicators, whether it is literacy, whether it's female participation, whether it's mobile phone ownership. If we want digitalization or we want digital money to come in, we will have to have more mobile ownership for women. Women's bank accounts are compared to men. There is a huge gap between the bankability of women. So we do know that there are going to be further gender inequalities, as there are going to be development or income inequalities across countries. There will be shifts in terms of access to resources across gender as well. So everybody needs to get their, roll up their sleeves and come up with solutions. We've got to have an all hands on deck approach to address these factors. For microfinance practitioners in particular, data collection continues to be an enabler to manage the pandemic. Digitalization, management information systems, new product lines that are more gender intentional will be some of the areas for us to help cope with the crisis. So thank you very much, and I'm going to stop here.
Thank you very much, Roshani. Very well done, a very informative and interesting presentation. So do we have any questions for Roshani?
Well, I don't have a question, it's just a comment. This relates to the data on the second last slide where you compare women with men in terms of accounts and mobile phone ownership and all of these things. It's really a bit disappointing to see these figures. Despite all the wonderful work that MFIs have been doing, it seems that women are still left far behind. And a lot has to be done to make sure that they are at par with men.
Yeah, unfortunately, the whole of South Asia is losing on Findex. This is World Bank data that I shared with you. There's a database which you must be aware of called Findex, which maps financial inclusion for women across countries. So all countries in South Asia are losing in terms of women's access. And we really, as the word I use now is gender intentional products, not gender centered. So that's really what we need to do more of. And we hope that with with every crisis comes an opportunity, and it makes us reflect on what we're doing well and what isn't working well. So I think the composition of the market will change, but to make women part of the digital divide, or to overcome the digital divide rather, we need to work on telephony for women as well. So mobile accounts themselves won't help. But on the upside, we have the cash transfer program that the government runs, and the money transferred is to women. So that's backed by mobile accounts for women. However, transactions don't happen in the account. So when you go and you introduce a mobile account now to women, the awareness is there, but the value proposition has to be created. So that's really the work that we are doing now at Kash. We are adding to every loan that we have, we are adding a mobile account to make sure that women learn how to use this and see the value.
Exactly. This is common across quite a few of especially in Central America, that all of the cash disbursements are done through electronically, through mobile phones. So which makes sure that women actually do open the accounts and they access them. So which is a good way to make sure that they are included in this. Okay, all right, thanks.
Okay, can I make a comment and ask a question? Hi, Roshani.
Hi.
I'm good. Thank you for presenting your wonderful work here. I would like to mention that Kash recently won this UN Women Asia WEP's award for COVID-19 action category. So I would like to take this opportunity to congratulate you for that. And I think it's an honor uh, for us and to have you here, you know, represent Pakistan on this forum. Well, I have a few questions. In the coping strategies, you mentioned that there was a use of digital technology by women when it when we talk about COVID-19. So there have been studies which show that mobile ownership turns out to be quite a significant factor. So do you plan to extend any such product in order to facilitate women cope well with COVID-19 and let digital technology play its role as a coping strategy? Another thing which I was thinking that you mentioned that it's COVID-19 is it has been, you know, having its implications on education, especially of that of children. So do you plan to extend any education loans as a product so that, you know, women can, again, HTI, in terms of HTI, if this could facilitate them? Thank you.
Thank you, Aisha, for those questions. First, on the mobile phones. Well, there are two sides to this. You can't just hand a mobile phone without creating the value proposition for it. You can't just open a mobile account without training or educating the clients on or the customers on how to use this and how how to transact it and what the value of the entire digital space is going to be. So yes, one of the things we are doing is we are training women on how to use, WhatsApp, how to use Facebook for marketing their products. So we've targeted all the women. What we've seen is that in our current customer base, 20% have a smartphone. So we are targeting those women first. They're the the cherry picking here that we're doing. They're the easier hanging fruit. So we are going for them. Incidentally, today we were talking with a provider of cellular phones to see if we can work together to get those phones, the smartphones out and move women from 3G to 4G and 5G ultimately. And how can we develop a strategy in congruence with our ongoing program? We don't want to go into lending for such a product, but we are looking at mobile phone providers who may be interested in this. So that is something that we are considering. And that has worked, for example, in Paulo, Kenya. They did a wonderful job in providing mobile phones as part of the loan itself. So yes, we can definitely, we are looking at that. Education is something we've already been doing for a long time, for about 6-7 years. We lend to low-cost private schools. And again, we do what we call the edupreneur approach, which is we work with the educational entrepreneur. We train them on how to run their schools and manage them better. And we train the teachers on on the pedagogy of learning. And then we provide loans. But unfortunately, we had 4,500 schools we were funding pre-COVID. Today, that number has gone down to 784. So almost 65%, 70% of the schools have not been able to cope with COVID lockdowns and the fact that they didn't have the infrastructure to retain their children. So yes, we do have that project, and we're going to continue to work with the low-cost private schools. We are engaging with the 3,300 schools that we lost to see what kind of products can we offer them to bring them back on track. And we are continuing to work with the 700 odd schools that we have currently and grow the program in the coming years as well once things normalize. If you're talking about educational loans, that was definitely in our pre-COVID strategy. We were going to provide educational loans to our clients to send their children to university because there was a demand that was coming up. The two big consumption loan requirements that we keep getting are educational loans and marriage loans. But in the current COVID environment, we are doing ration loans, as I shared with you, what we call the Insta loan for up to 10,000 rupees. If you need money to buy rations for your family, you don't have the money, come to us and we'll give it to you. So those are the ones that we, on the consumption end, that we do have. But the longer term, life cycle event change kind of consumption loans, we are going to do when things normalize. If we ever go, if this is the new normal, then we'll have to think differently. If normal is what we are wanting it to go back to, which is pre-COVID, then maybe we'll have to we'll have to wait for a bit. The tail is long.
I think it's all about, coping with the times. So, just keep making strategies that work well for both sides. Um, may I also know that you mentioned that some of the MFIs, and like you also spoke about your organization, that you changed the repayment mode. Was that one strategy to cope with
Yeah,
this
we had to
situation?
reschedule. Yeah, because they had lockdowns, they didn't have incomes. As I shared, 92% of people at the time in April, we locked down, Pakistan locked down on 22nd March. We started the surveys on the 23rd of March. We started calling our clients. And what we discovered is 92% didn't have any income. And we knew that they would not be able to pay us in April. So we rescheduled automatically in April. And then we offered them different tracks. Now, the interesting thing on the tracks was we had assumed that when we offered people a 12-month reschedule, payment gap for 12 months, they would all choose that. Interesting enough, only 10% chose the 12-month, and 90% chose the 90-day, within the 90 days, 60 and 30, 60 and 90-day option. So what it told us was that our entrepreneurs were more resilient and more optimistic than we were engaging them. Because obviously they were closer to the problem than we were as an institution. So that also was an eye opener for us. And 92% of the people paid back on time.
That's very interesting and a bit shocking for me to know that people were ready to be so efficient with regards to the repayment to do. So that's a very encouraging thing that it's happening, and I appreciate the work that Kashf is doing. So thank you very much. Any other questions from the participants, please?
I think Dr. Emanawaz has a question.
Yeah, actually, I had a question, but I think Roshana already discussed that. It was all about repayments and the concessions which Kashaf has granted to their clients. But I have another some comment. It's more of a comment. Considering the fact that what in terms of loans during I mean, you mentioned it was a sort of longitudinal study. You got to the clients when the lockdown started on 22nd, in the month of March, and then you again revisited them in, I guess it was in April 2020, and then there is another, like after 6 months, you again revisited them. So there was a sort of rearguard action. I mean, things were quite in a disarray in the beginning, but there are readjustments, particularly when you last reach to the clients. So there is an optimism which you already mentioned. So what I'm really wondering to know is to how much you are confident that that is because of the policies in place, what you have already mentioned, is because of that some sort of optimism and things they are certainly coming back on track, or is it more of a outside change because normality sooner has to resume, and overall businesses, they are opening up and all that sort of. So how much you are confident about, based on your exactly the survey, longitudinal surveys in 3-way which you have conducted, that it's because of your own Kashaf policies that things have started getting back on track as far as your entrepreneurial clients are concerned? That is, I'm really exactly wondering.
Okay,
about.
so
Thank you.
Thank you. So crises are both external and internal. When a crisis hits, it brings out the weaknesses of the institution, and then it also pans out in terms of the sector that you fund or you're working in, or it also pans out to the economy that you're part of. So in our case, it's interesting because we have, as you know, we had a complete lockdown in Pakistan in April. After that, we've not had complete lockdowns. We've had smart lockdowns, and we've had 2 more waves of COVID in this process. So in some ways, we have learned to cope with or manage the lockdowns and how and to reach out to the clients. So one of the exercises we did, which was very useful for us, and which we could do, is because we are digitalized on the back end. So and it's become what I now call the Starbucks approach to doing microfinance, because you really don't need offices anymore. You don't need physical proximity. You give a tablet to a staff, frontline staff, and they can do GPS and they know exactly where the client is. They can contact the client. The client puts the money through the agents, the branches banking agents, or through their mobile accounts. So a lot of if I may call it, the infrastructure, the digital infrastructure was in place prior to COVID. So many of us could just piggyback on that. So yes, external opportunities were there that existed, but then there were internal decisions also. So you're right, it's a combination of both. The internal decisions were first to listen to the clients, second to ensure that we were compassionate and we could provide them opportunities and pathways out of the crisis. The third was that we were ready to take the hit financially. So if you look at our numbers, financials for June last year, we weren't as sustainable as we were in the earlier years. So we had to take the hit of rescheduling for the first 2 months. But that was fine because this helped the clients come back on track, and we generated the pathways. We didn't let go of any of our staff. That was also a very important strategy we used. So it's a combination of both. It can't just be a one avenue. But in case we go to a national lockdown again, that's going to hit the sector very hard. Smart lockdowns, we've learned how to manage. Because these are community-based, and since you run a diversified, portfolio across the country, if let's say Multan and Naushehra, Firoz are locked down, like Sindh, parts of Sindh and Multan are locked down, or Punjab are locked down, you still have 85 to 90% of your operations working, so you can manage. And then even the lockdowns now, as I shared with you, are no longer the lockdowns that were happening earlier. And businesses and demand is coming back. For example, we just did a very quick and dirty survey to see how many of the women who were running beauty salons have opened up again. So we saw 85% of them have opened their businesses. So, you are seeing business activity happening. The returns may not be the same, the revenues may not be at the same level, but the incomes are coming in. So the optimism is also feeding through. But yes, these are unpredictable times. So let's hope that we don't have another massive wave of COVID coming back. We need to do vaccinations, of course, as we all know. So.
Thank you. We have Professor James Coopstake here. Professor James, are you with us?
Yes, I'm very sorry I missed the the presentations. It was unfortunately I had no option but to be somewhere else. But sounds like from what you've just said that you've been having very interesting conversations, and that although there may be no positives to COVID, it is still an interesting experiment for those of us who are social scientists to stress test financial systems. And I'm particularly interested to hear what Roshana was saying about educational finance, and this the extent to which there is risk sharing as you move up the financial system, the willingness of external sources of finance to bear some of the risks and costs that arise from unforced reductions in people's ability to repay.
Yes, just to continue further, I think the external sourcing factor is very important when it comes to enabling the developing countries, MFIs, to extend different products and to introduce product diversification, especially with regards to coping mechanism against COVID. I think the role of international finances would be very crucial. So next we should look at that also, and because it is, I mean it is a common it's a matter of common understanding that in developing countries, the MFIs, they rely on external sources of financing to extend their services. So COVID-19 could bring such challenges could accentuate this standing of the MFIs also. Yeah, make them more vulnerable perhaps financially. Yeah. Thank you. Do we have our next presenters with us?
They have some internet issue. They have joined us, but they won't be able to present. That's what they're saying. So they won't be able to manage. And Roshane, she has to leave. I think she left. Thank you, Roshane, for your time and for such an informative presentation. So if we don't have any questions, I think that finally we have come to the end of our session. Do we have any questions, Dr. Asad and Dr. Eman? Aisha?
Well, if we have Philip with us,
Yes, he's with us.
Hello, yeah, I'm with you.
hi, Philip.
Uh,
We've been asking you a lot on product diversification, income diversification and its impact, uh, because it interests me, and it was interesting to have this finding from your side also. Could you please share this slide in which you had this ROE and relative to income diversification? What was basically the outcome of that? What did you conclude from that particular finding?
okay, Aisha, I'm not very clear on the particular slide you want me to share.
It was perhaps in your empirical analysis. Yeah.
Okay.
Let's see.
Okay, do you mean these findings?
These findings. The one that caters to ROE. All that
Okay,
I'd
so
like to know is that why did you have to take ROE?
okay,
Yes,
okay. In accounting, when measuring performance, we usually measure profitability by ROA and then ROE.
yes,
ROA is for the return on assets that is generated, and then ROE is for the return on investors or shareholders' funds. So there are times where there might be some analysis, and then the impact on return on assets might be high, but the effect on return on equity wouldn't be as high as return on assets. So we try to use two metrics for measuring performance to see whether the impact of the income diversification or the independent variable is significant on performance, both on ROA and then ROE. So that's why we also added a different model. We didn't include it in the same model, a different model for ROE. Okay, I don't know whether I'm answering the question. Is it clear, or I should?
it's fine. You mentioned about tangible assets that they are more profitable. I mean, how does your result uh, prove this thing or make you conclude this?
Okay, thank you very much. And it's a very good question. And we also questioned it when we conducted the study, because in the knowledge economy that we are transitioning into now, we expect that intangible assets and then the expertise of board of directors, the expertise of managers and staff in microfinance institutions should drive performance tremendously. But our findings from MFIs show that fixed assets and tangibility drive performance better, which means that the more fixed assets and then the more visibility that the company has, the better it performs. Now, in the African setting, the microfinance are there to meet the needs of the low income households, and then small, and they are usually in the rural areas, and they are not really able to access the intellectual capacity or the intangible assets of companies because of their low level of education. what they depend on is physical presence and physical location of the microfinance in their community. So if an institution, a microfinance institution in a village has highly skilled personnel, but does not have a big building, and then there's another MFI institution in the same vicinity, has a low level of skilled personnel, but has physical presence because of the community that it's in, especially in the rural areas. The indigents or the low income household place value more on the physical assets they can see and can trust that when they deposit their money with this institution, they know that if the money is still there and then they go and come back, they can trace the institution and find the institution and then take back their money. So there are higher chances that an institution with more fiscal presence, which is measured by tangibility, will attract more borrowers and attract more clients. Yeah.
Thank you.
Thank you very much for the question.
Thank you, Philip. And do we have any more questions?
No, nothing.
Well, thank you everyone for attending this session. Thank you so much, Philip. We have been asking a lot of questions, and well done for your presentation. Thank you, Olayami, she just left. And of course, thank you, Roshane, for your time and for such interesting presentation. So with this, I think we come to the end of our session. Thank you all for your contribution. Thank you, Dr. Asad, Dr. Ahmed, Aisha, James, Ruxana, Marco. We would have loved if you would be able to present Marco and Angelina. They have some issue with their internet. So I hope this is it. Thank you, everyone.
Thank you, Faria, for hosting this interesting panel. Take care, everybody. Bye-bye.
Thank you.
Bye, everyone.
Bye-bye.
Bye.